Just a couple, like I said, a couple administrative things. You should have received the Chapter 7 and 8 quizzes and problems answers. If you didn't get that, just pop a message to me in the chat. Did look like a couple bounced back, but it didn't tell me who it was. So just let me know there. We have a lot of material to get through today. Actually, we're going to cover 3 chapters. The last 2 are going to be just on the itemized deductions, so those won't be too bad because people are more familiar with those. But we're going to also be covering retirement. We'll do a couple problems at the end that I'll go through. We had a couple questions. Somebody wanted to go through some of the exercises in Chapter 8. So we're going to go through that. We were looking at page 8-9. There were some true-false. Okay, so if anybody, well, this is a multiple choice one. Okay, so on the multiple choice, all right, we'll kind of go through these, and if anybody has any questions, like I said, pop those in the chat. The other administrative thing too is, as you notice from the syllabus, I will be emailing out today the written take-home, the midterm. It is open book, obviously, so that you can do that and get that back to me. And then we will be doing, next week, we'll be doing the computer midterm, and I'll be sending that out, okay? The computer midterm is just a problem for everybody to see where they're at as far as everything. The homework's been looking great. So, but, and as I said last session, if anybody has any questions, please let me know. I'll try to cover them in the lecture so that they're there for everybody to kind of get the information. But we will, if need be, if somebody's local and they'd like to sit in on a class, we have plenty of classroom times where you can sit and everybody can talk if you want to get caught up that way. And then also you can see if you need to set up a individual Zoom session with me, okay? All right, and I apologize if I sound a little congested, a little under the weather, so I will keep you try to keep things as clear as I can when I talk, so, okay? All right. The question on page 8 and 9, we're on 8-9 exercise A, okay? It was the case that Dale bought land and a building for $60,000 for use as a parking lot. He paid $7,000 to have the building demolished. Dale received $1,500 for granting an easement through his land in 2016. He then paid $11,000 to lay down asphalt for the lot. What was Dale's basis in the parking lot at the date of sale? Okay, well, the answer is C. And the way we get to that, if you take the $60,000 that he paid, okay, $7,000 for the demolish, and the $11,000, and then back out the $1,500 that he received, you get to the $76,500. Okay, so you know, if you go back to the little chart that's on one of the previous pages about things that increase and decrease the cost basis, that's how those numbers all work in there, okay? So all the numbers are pertinent. Some of the numbers in the other exercises on this page you'll see when you look at the answers. Some of them really are there that they're just information that isn't relevant to figuring out the answers. But in this case, everything that he did for the purchase of the land, the improvement of the land, and the asphalt, those all were added to the basis of the property, and then he had to back out the $1,500 that he received as income on that property for the adjustment to the basis. Okay? Any questions there? All right. And again, if any questions come up, just pop them in the chat so we can have them there. All right. Okay. We're going to take a look at page 816. We had some true-false questions. Okay. And again, there's a lot of information in here in the chapter on capital gains. But as I said before, really what I want you to focus on is, in the capital gains section for right now, is that stock knowing that you do your basis and what the basis is and what the proceeds are, knowing how to use that Schedule D for that, that you do that on the worksheet so that it carries forward to the 8949, and then you make sure that you understand the categories, the A through F, with the short term or long term, okay? There's a lot of other stuff in here for capital gains, like I said, that we'll come back to and circle back to with some things when we get to the investment property. It's much easier to see it in action within the Schedule E that we'll do in let's see, what chapter is that? That is when we get into chapter 15. We'll see a lot more of how that adjustment to basis works when we have business income or property or anything. All right. Hold on one second here. All right. Okay. All right. Now we're looking at, let's see what page we're on here. I think it's 816. Some true-false questions about the capital gains, okay? The sale of stocks will be reported to the taxpayer on a 1099 DIV. That's false because that is the dividend document that would come. The sale of stock would be reported on a 1099B. I believe I sent out to everybody a sample of what you would see more often for a 1099B. The Fidelity one, where you see that type of format, kind of a landscape piece of paper with the Schedule B, or excuse me, 1099B on there, and it has the different information in that form. Okay. All right. Number 2 is the basis of an item is always its purchase price plus acquisition cost. That's false. Okay. On that one, we have to do other factors that would be in there that would adjust the basis. Could be things with improvements and cost or things like that. Okay. All right. Okay. All right. Number 3, fair market value is the price at which the property would change hands between a willing buyer and a willing seller, neither having to buy or sell, and both having reasonable knowledge of all necessary facts. That is true. I think I've used the example of the baseball card. Okay, that Babe Ruth rookie baseball card, collectible. Okay, really the only cost basis we would know is that somebody probably paid a penny for it in a bubblegum wrapper. Okay, however, the fair market value is going to be that somebody is a buyer and a seller, that they're going to determine the fair market value of that card at this time because of what the willing buyer and seller may be willing to pay for it. Okay. Number 4, the sale of inherited property is always treated as a long-term capital gain, regardless of how long it has been owned. That is true. Okay. Because inherited property, the basis, it was held by somebody for a long period of time, so it's going to be greater than the year for that long term. Okay. Number 5, the tax loss from the sale of an asset is limited to $3,000. Kind of a trick question. Okay, that is false. Okay, the $3,000 limit is the maximum amount of capital loss that we can take on the return each year. It is not limiting the loss. Remember, we have carryover. So if there's a $3,000 loss, we use that $3,000, but we have a total of an $18,000 loss, so we do $3,000 in the year, and another $15,000 would carry over to the next year. Okay. The gain from an asset, the gain from an asset held for 1 year or longer is considered long-term. Okay. All right. So again, kind of a tricky question the way it's phrased. The gain from an asset held for 1 year or longer is considered long-term. All right. Okay. A long-term is something that is held greater than the year. Okay. All right. Let's see here. What page? 822. We had some more true false. It's exercise 8C. Okay. These questions ask if a taxpayer sold their primary residence. Okay, again, that's the other part of capital gains we need to talk about. Everybody tends to have this mindset from going back, I think the law is from like 1990, I think this changed in like 94, 97, somewhere in there, that you get a kind of a one-time get-out-of-jail-free card as far as the sale of your primary residence for no capital gain. But remember, we have that rule, 2 of the last 5 years, okay? So we have David and Janet sold their primary residence, which they purchased in 1991 for $250,000. They lived in the home until the date of sale. Well, if we use this year, okay, if that's when it was sold, then they've met the 2 of the 5. The home was sold for $675,000. Since the gain from the sale was more than $250,000, they are required to report the sale on their return, okay? Remember, this is, it says up there, their exclusion is $500,000, okay? $250,000 if it were single, $500,000 for married filing joint. So we take the $675, we minus the $250. If that is not greater than $500,000, then they can exclude that capital gain, okay? Even if the gain, number 2, even if the gain from the sale of a primary residence can be excluded, the sale must be reported on Form 8949 and Schedule D. That is false. Unless a 1099-S has been issued by the attorneys or the closing or the sale and purchase of the house, that is false. Okay? Most property owned and used for personal purposes, pleasure, or investment is a capital asset, i.e. home, furniture, cars, stocks, and bonds. Number 3 is true, okay? Right at the outset of the chapter, we talked about the fact of what those capital assets would be, okay? All right. Number 4, while a home and mobile home both qualify for the exclusion of gain, a houseboat does not. That is false, okay? Remember when we saw that part of the chapter where it listed out all those things that could be considered a home, all right? And then number 5, what are the 2 tests required to claim the exclusion from gain from the sale of a primary residence, okay? Ownership and residency. You must have owned it for at least 2 of the last 5, and residency, you must have lived in it for 2 of the last 5, okay? So those are those, okay? We had one question on the quiz in Chapter 8. So question 4. All right, so if you want to go to the quiz, which is on page... I'll through the exercises here. Give me 1 second. Okay, the quiz on Chapter 8. So we were looking at question number 4 is what somebody had a question on about that one. Okay, so question number 4 here. All right, what are 2 things that must be true in order for a non-business bad debt to be deductible? Okay, the first one is the taxpayer must have a basis in the debt. They must have some type of vested interest, okay? And the debt must be totally worthless. Again, kind of some things from the reading. Didn't spend a lot of time on this when we talked about it just because I'm going to cover a lot more of this when we get to Schedule C, where you see it in action, so that you can kind of see how it works. This part of the capital gains, we want to touch on it just because it does impact on Schedule D. But as far as origination, we'll do a little bit more, like I said, with that and the personal property when we get into the rental property and Schedule E. Okay. Okay. Any other questions? Like I said, I sent that out. I will be sending out the problems, the PDFs of the problems, so you can take a look at where you're at with those. Everybody's been coming in great with those. Everything looks good. We'll do a couple more problems today that'll be over the chapters that will be covering. Okay? All right. So we're going to move on to Chapter 9. All right? Now, I'm sure all of you read this and felt like you had to take a financial advisor's class to be able to understand all of the things that are going on, okay? And then to throw it on top, you know, my in-classroom people said they hope they never meet somebody that works for the railroad just because of the different way that the railroad handles its retirement, okay? I'm going to try to simplify it as much as I can so that you understand what the bare bones are that we need to know. We're not going to get into a lot of the conversions and different things like that. The main thing I want you to get out of this chapter is when that individual or that client comes in with a retirement account, that you understand how that 1099 works, all the information that is on the 1099, and how you need to handle it on each of the tax forms, whether it be the federal or the state, okay? So those are things that we want to make sure that we cover, all right? Like I said, there's a lot of other stuff that's in here that gets into some pretty deep finance stuff with all the different types of retirement accounts, but we're going to take the things and get the stuff. The other stuff that's in the chapter, to be honest with you, in the tax season when I'm doing returns, not a lot of that comes up. That is more so when I'm here during the off season and I am doing consultations with somebody and they want to know, they talk to their financial advisor and they want to do this with their retirement or they're getting ready to retire. And it was a matter of how, if you will, how the tax implications are going to affect it when they put all these things together so that they know. And equally, you hear most of the time on the little commercials or you see in your reading, when you get a brokerage account or a retirement account, first thing it says in there, please consult your tax professional for any other information. They need to know what that tax liability is, okay? All right, so we're going to get into Chapter 9 here. And again, you have the chat, so if anything comes up, let me know. All right, so as we said, this chapter deals with the disbursement of retirement funds. And that's what really going to be what we do and where we handle with it is we are kind of on the back end after somebody has chosen to take and have these funds dispersed, okay? They're taking a withdrawal from their 401k. They're retired, they're receiving their pension or their Social Security or they work for the railroad, okay? We're going to talk about qualified plans and non-qualified plans, all right? And we'll talk about the tax implications there. We're going to determine what of a pension or annuity or IRA is taxable, okay? So if you take a look at the bottom here of page 9.3, okay, where we're talking about the objectives here, this is really what we're going to concentrate on, all right? We're going to concentrate on the tax liability, determine the taxable and non-taxable portion of Social Security and railroad benefits, about the taxable portion of a distribution from an IRA or a retirement plan. We'll talk a little bit about rollovers, okay, and how those are handled, and how everything is coded within the tax return, okay? All right. Retirement plans. Basically, they're divided into qualified and non-qualified, okay? The term qualified is used to describe both retirement plans and other investments. From a non-technical standpoint, a qualified plan or investment is one funded with pre-tax dollars, okay? What that means is if it's something like a 401k, or if you contribute to a traditional IRA outside of your employer, those are things that are lowering your income before the tax is calculated, okay? In the case of your 401k, we remember that we see that D code on the W-2, okay? All right. And I had a question. We'll talk a little bit about a Roth, okay? So we'll get into those with the differences there, all right? The qualified plans are also tax deferred. Well, what that means, if anybody's retired or anybody's ever dealt with a traditional IRA, it means that if you don't pay tax on that money and it's going in, it's not tax money going in, then it's going to be taxed coming out, okay? A Roth will be just the opposite, okay? All right? A Roth, you're using tax dollars on the way in, tax-free on the way out. The IRS and the government is always going to get its share of taxing it. It's just a matter of when that tax is calculated, okay? In here, it talks a little bit about RMDs, okay? Required minimum distributions. I always tell my classes that there's several birthdays in life, okay? You get that 18, you can vote, 21, you can drink. The next one that usually comes up that is exciting for you is 59 and a half, because that's when you can start to take money out of a retirement account without a penalty. All right. Next one may be 65 or 66 for Social Security, 65 for Medicare. And then the other birthday that you get to celebrate is 70 and a half. 70 and a half, the government says you are required to take distributions from your retirement accounts, okay, unless you are still working. All right. So there's some things that play in there. Like I said, the big thing is when people want to take money prior to 59 and a half, there is a 10% penalty, okay? People kind of forget to, and a lot of times there's a mandatory 20% withholding from these retirement accounts, but we have to make sure we understand that when we talk to somebody that not only is it taxable income before 59 and a half, but it is also a 10% penalty. So that's where that mandatory withholding will come in, all right? And again, it is when they turn 59 and a half, okay? We'll talk a little bit when we do a problem. I'll show you with the New York how they handle it, because if somebody is born in February, okay, they would turn 59 and a half in the year in August, so they can only exclude the last 4 months as far as income, because on the New York returns, any income before 59 and a half is taxable. After 59 and a half is non-taxable. So there are some states that use that 59 and a half, similar to the federal, to determine when it's taxable. So it's not just that you turn 59 and a half, they break it down by the month, okay? Non-qualified is also used to describe both retirement plans and other investments. Again, non-technical standpoint, a non-qualified plan or investment is generally one funded with after-tax dollars, okay? So, after-tax dollars, that means that the money that's going in there has already been taxed, okay? That you've already paid tax on that money, so that when it comes out, it is a tax-free disbursement, okay? All right, Form 1099-R, all right? That is going to be our lifeblood, all right? It's where we're going to see all the disbursements from pensions, annuities, 401k, 403Bs, 457, profit sharing, all these different things come on the 1099-R, okay? We'll see that when we do the problems, all the information boxes that's on there that kind of tells us what it is, okay? So that's where we have to know and understand the terms as far as what it is to make sure that when we put it on the return and we place that 1099-R in our return for our client, that it is handled correctly as far as the taxable portion, non-taxable, what happens to it on the state, is there a penalty for early withdrawal, and all those things that are there, okay? Again, a lot of reading for you here as far as pensions, annuities, IRAs, kind of explaining what each one of those are. We'll see them as far as those things when we see the 1099-R in action on a problem, okay? All right. Down here, it talks about partially taxable payments, pensions and annuities, okay? What this is, there's two methods. The tax-free part of the payment is figured using one of the following methods. The general rule, this method must generally be used if the the pension or annuity is paid under a non-qualified plan. This method cannot be used if the annuity is paid under a qualified plan, okay? The simplified method, this method must generally be used if the pension or annuity is paid under a qualified plan, okay? Or a tax-sheltered annuity plan. The method cannot be used if the annuity is paid under a non-qualified plan, okay? Again, some terms you don't see a lot of the general rule. You will see some of the simplified method. I'll show you that again when we get into the problems, because in the software at the bottom of a 1099-R within TaxWise, there's a little table, a little formula, a little worksheet that helps you calculate using the simplified method. Okay, so we'll see that in action there. Okay. Here is a simplified method worksheet. And again, it's kind of showing you an example how the IRS does it. The one that we're going to see when we do the problem with the 1099-R is much easier to understand and follow. Okay. This one, again, typical IRS worksheet. If you like, you do 4 lines, you get an answer and it says, okay, if it's this, then go back to this one. So we're going to see it in action when we do the problem. Okay. All right. I'm going to touch here a little bit on disability pensions. Okay. It's one of the questions that is on the quiz for Chapter 9. All right. But disability pensions, if that is coded 3 for disability, then you can have that income reported on line 7, all right, okay, until they reach the minimum retirement age. What that does sometimes, Esther did a radio show one time on this during tax season, and her Saturday radio show, and come Monday morning, the phone started ringing off the hook because she explained the fact that somebody that's receiving disability can have that calculated as basically line 7, which we know tends to be earned income. It may make them eligible for the earned income credit, and they may get more on their refund. It has to be a perfect storm with the situation for that, because what we know our rules to be of things on the earned income side of it for the earned income credit, but it is something that does come into play. Okay. Rollovers. Rollover from a qualified retirement plan. Most of the time, you're going to see a rollover on a 1099-R coded G. That's the code for rollover. And most of the time, this is going to be a rollover that is from trustee to trustee. It never really goes through the recipient's hands. Okay? So that's where that rollover happens most often. That's what they would call a direct rollover. Like I said, it's handled from, somebody leaves an employer, their 401k, and that employer, then the separation, they decide they want to roll it into their new plan at their new employer. So a trustee to trustee, okay? However, sometimes somebody leaves a job and they have a rollover that a 401k that they receive a check on. Well, there's a 60-day rollover, okay? If you receive that check, all right, you have to make sure that you use that 60-day rollover to roll it into another qualified account. All right, so that's where those two things with the rollovers, that's where we're going to see most often. You have to make sure that somebody understands. The thing about it is a lot of times when somebody leaves a job, they're probably under 59 and a half to go to a new job. They have to understand if they don't designate that rollover and they do that, handle it correctly, that they could be subject to that taxable income and that 10% penalty, okay? But most of my clients, if they get that check, they'll say, what do I do with it? And I said, you got it, go right now, put it into a traditional IRA at your bank so that you can say that you're within that 60-day rollover and you'll have that time to determine what you want to do with it. But it just keeps it from slipping through the cracks and ending up on somebody's return where then it's taxed heavily and it's penalized. Okay. Some pretty good examples there, some rollovers. We won't get into a lot of things about, like I said, the things with the rollovers as far as those special circumstances with spouse and beneficiaries. Don't see a lot of that when you're doing the returns. That's something that you may do and have reference here to if you're doing some financial advising on the side with people outside of doing their tax return. Okay. IRAs, all right. Traditional IRAs, most contributions are deductible on the tax return up to the limit. Therefore, most distributions from a traditional IRA are fully taxable as ordinary income. If contributions were non-deductible, then distributions are partially taxable. What this means is sometimes it is your money. Sometimes that happens with a Roth where somebody, after the holding period, will take money out of a Roth, but if they're taking the portion of taxed dollars that they put into that and they take that out, that would be non-taxable, okay? So you have to really understand what portion of that is a portion that is tax dollars and maybe partially taxable, okay? And again, the coding that we're going to see here shortly when we talk about the 1099-R, you'll see that that coding will give you that guidance as to what it is. A lot of times on that little 1099-R that you get, it doesn't tell the whole story. Once you see the codes, you're going to have to ask a few questions. Where did this come from? What's money? How much? All these different things that may be in play, okay? Again, we talk a little bit about the RMDs in here. That's 70.5, okay? There are instances with distributions when you take something out before 59.5, it refers to a form called a 5329. These have things that calculate the additional tax, but it also has things where you can do different things to exempt that penalty for an individual. Prime example, somebody takes out for their first-time home buyer, they take out $10,000 of their money for the down payment from their retirement account and they're under 59.5. While the money coming out is still taxable, we can exclude the penalty because there's that exception to the rule that they're using it for that first-time home buyer, okay? Here we talk a little bit about Roth IRAs. Contributions are non-deductible because we're having this go in there. We've already paid tax on it, okay? So as it says, contributions grow tax-free. Therefore, qualified distributions from a Roth IRA are non-taxable, okay? Because we've put taxed money in there, all right? Talks here about a qualified distribution is any payment or distribution from a Roth IRA that meets the following requirements. It is made after the 5-year beginning with the first taxable year. So there's that holding period that comes into play, okay? We also do, though, because of Roth IRAs with things like that, a 10% penalty is applied to distributions with the following exceptions, okay? Remember I was talking about some of those exceptions that may come into play. You can see these here. There's ones other than the fact of it's used to buy, build, or rebuild a first home, okay? You may become totally and permanently disabled, all right? You may become unemployed and you need to pay your insurance premiums during unemployment, okay? So there are different things that would allow you to exclude that 10% penalty. Great little table here. It's a great point to bring up where it talks about the differences between a Roth and designated Roth, okay? As you can see, most of these talk about from the left to the right, the big things I want to have you point out is the contribution limits. In a Roth that you would do on the tax return, you're limited to $5,500, or there's a catch-up if you're older than 50 is $6,500. However, if that plan is something that is through an employer, you may have a ability to do up to $18,000, okay? And that $18,000 is your money. It doesn't include the match that may come from your employer, okay? The also thing that I want to point out here is down at the bottom, it has a little spot where it talks about loans, okay? Just going to touch on that briefly here, all right? The Roth IRA that you have that is yours personally, that maybe you have at the bank that's outside your employer, would be something that you would not be able to take a loan from. If it's a designated Roth through an employer plan, you could take out a loan. I always caution people with this, okay? Because taking out a loan sounds like you're loaning money to yourself, but if you miss a payment, then it is a default, and then it becomes all taxable with the penalty, okay? So you have to be very cautious. I always tell everybody to make sure if they're doing this from an employer plan that the repayment is done as a payroll deduction, and make sure if they're separating from employment or retiring that they address the fact they have to pay back the remainder of that loan, okay? All right, great little table here, okay? Again, this is out of the IRS, talks about rollovers. If somebody has a question, says, hey, I want to roll over from this to this, okay? All right. It says here, the following chart indicates the rollovers that are permitted between various types of plans. So you can see and talk about when you can go from one to the other, all right? And sometimes it talks about the fact that when we make that transition, we may be going from one type of tax situation to another. So that distribution or that change would be something that we have to do as a taxable event that we pay tax when it moves, okay? All right, some more things about the rollovers and the waiting periods, all right? Okay, and again, some of the stuff is not things that really come into play when you're doing the tax return. It's much more something that you'll do when you're doing a little advising to them as far as how to handle their money. So if they're getting ready to retire or they're talking with their financial planner, what they need to know and understand that as they get ready to use this money or move this money to prepare for retirement, what the implications may be, okay? Been talking a lot about the 1099-R. Here's our little 1099-R. Like I said, for retirement, this is our lifeblood, all right? Has all the information we need to know as far as how we have to handle that 1099, or excuse me, that disbursement from pension or annuity or any type of retirement plan, okay? As I talked about, if you look here, okay, kind of continues on 2 pages here, all right? We have the codes, and then there's some of them that continue over here on the other side, okay? So there's several codes that we have. As you'll see on the quiz, there's about 7 that are really important, okay? We talked about that early distribution, a code 1. Sometimes an early distribution can be an exception for under 59.5. Maybe somebody's pension, they have a retirement that is forced at 55. Well, it can be coded 2, and they don't have to worry about the 10% penalty as just a taxable event. Talked about disability, where we said that that could end up on line 7 as earned income. 4 is a death benefit. Somebody is a beneficiary to a traditional IRA that would show up as a code 4, okay? 7 is the one you're going to see most of the time. That's a normal distribution, okay? That just means, well, normal distribution, it's taxable as income, but there's no penalty involved, okay? The other one that you see over here on the bottom on the other side is talks about a rollover. There's a code G, and then also you see Q, which is a distribution from a Roth IRA. 95% of what you'll see on a 1099-R will come from those categories, okay? All right. Okay. I'm sure when you read this, as I said at the outset, this is where we're going to talk about the fact that railroads, somewhere along the line, set up a deal that they handled their retirement totally different, okay? So we're going to talk about, and it's a shame the book's not in color because it talks about blues and greens and colors like that, okay? What I want you to remember, we're going to talk about Social Security, the SSA 1099 form. That's the one with the pink boxes, okay? So a lot of times you'll hear me talking about pink, all right? As far as railroads, we're going to talk about the blue, okay? So both those, the blue form on the railroad and the pink one for the Social Security, think boys and girls, pink and blue. They go together. They're going to be handled the same way. They're handled like Social Security, okay? The green is going to be handled like a pension or annuity, all right? So what we're going to do is talk about this. The problem I've selected to do from this chapter is going to have railroad, so you can kind of see it in action. But a lot of stuff in here where it talks about a lot of things, but what I want you to boil it down to is that Social Security, pink box, Railroad retirement 1099 blue box, pink and blue, boys and girls together. Green is the money from the pension. All right, green think money is a retirement account so that you can keep those separate and how those are handled. All right. Social Security, like I said, this is a shame it's not in color, but this one that is kind of a shaded box here, box 5, that is going to be the pink box. When I'm with clients, it's a little one where you tear off the little dog ears and unfold it with the gummy glue, and it's pink boxes. It's going to show their benefits that they receive from Social Security or Social Security disability. Everybody will get one of these. What we're going to use is when we do their taxable Social Security, it's box 5, and then in box 3, it has a description of all the things that may be in there. Okay, it may show their Medicare that was withheld, or their federal tax withholding that they decided to take on Social Security. As we're going to see, Social Security can and cannot be taxable. Okay, up to 85% of your Social Security can be taxable depending on what is in the return. And we'll see that in action when we talk about Social Security. Okay, talks about the different boxes are there. Okay, as I said, here's the blue form. All right, when we do the problem with the Social Security and the railroad in there, we'll see how it's handled. Pink and blue, boys and girls together. Okay, so we're going to have that with the blue form. Basically, this is their version of the Social Security and how it's handled. All right. This is one way of talking about how you figure how much of your Social Security may be taxable depending on a lot of factors with age and income and other things on the return. Okay, it is good. All right, it is a typical IRS form. Tends to be a little bit back and forth and stop, don't take this, now go to line here. Okay, on the exercise that you have, at the very end, there's an exercise to talk about calculating somebody's Social Security. This little table that's here at the bottom, this is the best one to use, okay? Because actually what this is, this little quick reference sheet, it is on the back of the pink box SSA 1099 for somebody to determine if their Social Security is taxable. Much easier. It's a quick way to check if the benefits are taxable. When I'm with a client and they may be asking a quick question about, hey, next year I'm going to be having a RMD, because I have to start, I've now stopped working, I'm over 79.5. Is it going to make my Social Security taxable? Well, we'll do a quick little calculation on the back of their form, and we can show them right there on the spot as to what would be taxable. Okay? All right. Okay. So again, we talk about the different things with the railroads and the taxable portion. I want you to see this in action. Don't get caught up in the text here because it's not real easy to follow as far as what is taxable, what is non-taxable, and how it's handled. When we do the problem for Chapter 9, we'll kind of see that in action. All right? Again, 1099 for the railroads, the Tier 2 as they call it. The thing I want you to remember, though, is if you take a look right here at the end, that tells us how we're going to handle 1099-R. I'll show you how to handle the R's as to where that goes in. Pink and blue, boys and girls together. 1099-R, the green, with the money. All right? So we'll kind of show that, how that is handled. All right. Okay. All right. Civil service and federal employees benefits. Retirees from the federal government, regular, phased, or disability retirement, survivors and beneficiaries of federal employees are covered under the civil service retirement system. All right. Part of the annuity benefits retirees or disabled retirees receive is tax-free of their contributions, and the remainder is fully taxable. Again, you're going to see that when you get that 1099-R from that. It'll have the boxes that'll go right into your 1099-R when we show you in the tax return, okay? In the case as it talks here, and when we see and I talk about the railroad one, you'll see the simplified method, because that box that shows the taxable amount, it'll be checked that the taxable amount not determined. You will use the simplified method to determine the taxable portion for that. Okay? And again, we'll see that in action when we do the problem in there. Okay? All right. A lot of material we've thrown at you here. Okay? So we're going to stop for about 5 minutes. Okay? So we'll pause here. Before we go in itemized deductions, I would like to do problem 9.2. So while we got a break here, if you want to get your workbooks out, problem 9.2 is for Ralph and Bernice Donald. It's on page 123 in the workbook, and we'll go through that, but I will be back momentarily. All right, so we're going to get into the problem here. Like I said, we're in the workbook. Problem 9.2, page 123 in your workbook. I'm going to read through some of the bullet points. I kind of have it up on the screen here to get started. It said Ralph filed a 1040 last year. He did not get a refund from his state. He would like to handle any refund or payment electronically. If he owes, he would like to withdraw it on April 1st. Okay. Use the information. Ralph did have medical coverage for the entire year. It talks about Ralph and Bernice have been separated since 2006. They have not lived together since the separation, but divorce is not final. Bernice has already filed her tax return, and she takes the standard deduction. So that's going to talk to or refer to our filing status. Okay. It also talks about Ralph retired from the railroad on June 4th, 2012. He was 65 when he started receiving the retirement benefits. He received his benefits for the entire year of 2016. Okay. Talks about Ralph has a part-time job in his W-2 forms. Okay. So we're on this. Well, if we start typing in the information, but we read our bullets, we find that Bernice is not really a married filing joint. So she's not going to be up here at the top. Okay. We're going to take Bernice after we put in Ralph's birth date. All right. As it said, he is, right now we'll call him retired. We're going to do a married filing separate. This is where we'll place Bernice's name in the return. All right, with her social security number. All right. We'll talk about the fact that it said that they did not live together since their separation. So as the question says here, did your spouse ever live with you in 2016? No. Okay. We're going to say that he is a New York resident. Okay, as you can see on the left, it populated us for our state return. We're going to e-file this return. It talks about the fact that if he has a refund, he would like to put it into his direct deposit. Okay. We're going to give him a PIN number. Again, driver's license, if he has that, you would fill out that information. All right. Okay. So, said Ralph filed last year as a 1040. Okay. Well, that means he probably itemized. All right. Okay. All right. But he did not have a state refund. Okay. So we can go down to that block and we will take and get rid of the refund. He has none to report there. The Affordable Care Act, as it says here, Ralph did have medical coverage for the entiree, probably something through his retirement. So he had that, or he had 65, he may have had Medicare. All right. So we have his information in there. Now we're going to take a look at his tax documents. Okay. On page 125, you can see his blue and his green, okay? But we're going to start with his W-2 information on the other side, okay? So we have, we're going to go to our 1040, page 1. Like I said, I always like to use the 1040 as my starting point, my reference point. I'm going to go down in my income because I see that he has W-2 income and a 1099-R. Well, I'm going to find that W-2. I can go to line 7, or I can go right over on my tree on the left and find my my W-2. Okay? All right. Taxpayer. It's for Ralph. His address is okay. We're going to put in his employer number on the W-2. All right. He works for Craft Tool and Die Company. We see his pay and his withholding. Now, class has been asking a lot, and I'll kind of touch on this real briefly at this point, okay, is that this little box sometimes lights up red, where it says, please verify the federal withholding, Social Security withholding, and Medicare withholding. The amounts exceed the publication 15 guidelines. Basically what that is saying is that it looks like his withholding might be a little bit low, okay? So you just want to verify that what you put in there is accurate, and maybe ask him. It may be a great time for you to kind of do a little consultation with it, all right? If we look at boxes 12 and 14, we can see that there's no information inside there, okay? And he had state tax withheld from his W-2, okay? So we've entered his W-2. Now, we're going to start to get into his retirement accounts. First one we're going to take a look at is that 1099-R, okay? And keep in mind, we've talked about age. We can see that we can remember from when we did the main info that when we put it in there, he is 69. Maybe a great opportunity because 70 and a half is just around the corner. Make sure you talk to him about, have you set up, have you established your RMDs so that you can do those? There's time frames. As it says in there, if you do not get the RMD done in the year that you need to by December 31st, there is a 50% tax penalty on the RMD distribution. So half of it would go to the government. So it's very important that you make sure that they follow that, okay? So on the 1040, we're going to look for retirement income because we have a 1099-R, okay? We go down here to lines 15 and 16. We can see that there's a whole bunch of information here about IRA distributions, pensions, annuities, different things to do with them. There's a box, if it would be coded G, that's inside there that may be something that I'll talk about if it's a rollover, okay? But when we get here, we want to go in and we can use one of the boxes. It doesn't matter which one because I'll talk about that in a second, but we can use that, bring up, there's our 1099-R. So we select that 1099-R, we go inside. Looks very similar to our W-2, but is for our retirement account, okay? Again, the important thing, and we'll talk about this when I go show you the New York side, is you make sure that you check taxpayer spouse. Obviously, in this case, there's only one because he's doing married filing separate. If they were doing married filing joint, you'd want to make sure that up here at the top that you check the correct box, all right, if it's taxpayer or spouse. Reason being is, I'll show you on the New York side, we have to make sure for the exclusions that may happen there, okay? All right, the address, we're going to put in the ID number. Okay, he had a distribution of $982. Okay. You can see here up at the top, it has the things that we talked about with the fact that we might see these boxes checked if there's not a taxable amount determined. We'll talk about that a little bit in a second here. If it's a total distribution, that box might be checked, and then we might see a code G, which means they took it all out and rolled it over. So pay close attention. You want to make sure those boxes go in there also when you're entering the information that's on the 1099. Okay. Box 4, you can see over there, talks about tax withheld. Sometimes distributions, they have mandatory withholding. Sometimes people don't have anything withheld because they really don't have any tax liability that they have to worry about paying them because of where their retirement comes from. Okay? We're going to get down to box 7 here, kind of at the bottom of the screen. This is where we're going to enter our codes. Okay? It will be coded for us like we talked about. There's about 7 codes that are prevalent, but in this case we're going to talk about the ones that go in there. And then you can see next to it, we would check the box if it's an IRA, SEP, or Simple. Okay? In this case, we have it as a code 7. The box is checked, probably a little IRA that he has at his bank. All right. Right below that, what I was talking about here is that if you take a look, all right, these boxes kind of work together for the disability. If we were coded 3, we would then check the box, check if disability and taxpayer is disabled. Checking that box then moves it to line 7 for us, where we might have the possibility of using that for the earned income credit. Okay? All right. Now, these are the other very important boxes. Okay? New York, a lot of times for the IRAs will not do state withholding because they just don't want to hassle with too many entities. Okay? So, a lot of times there's no state tax withholding, and it may be the case that it's not taxable, and that would be the case in New York. Okay? So, over here on the left, we have these boxes that have just a description. It says, for state, use these boxes. Okay, it's in red. All right. Box 1, we're going to check that if the individual has reached 59.5. Box 2 is if that pension comes from a federal or state government. Okay? And we'll see that because this is how it applies on the New York side. All right? So, in this case, for this annuity, we know that he's 59.5. Okay? So we're going to check that box. What that does is I'm now going to go on my tree on the left, and I'm going to go to my New York 201, page 2. All right? If I go over there, I can see the first section up at the top has all of his federal information. Down here, we have subtractions. Okay? And if you note, in the middle here, it talks about pensions and annuities. Well, he reached 59.5, so he's able to subtract that $982 from taxable income. All right? So he's able to take that out of there. All right? So this is where I was talking about. If you look inside here, there's a little thing. If it were the case that he had not, at the point he reaches his 59.5 birthday in that year, he can only take that disbursements that would happen, or that would be tax-free, and subtract them that are after his 59.5 birthday. Okay? So if the money's coming out equally in 12 payments throughout the year, then he would have to calculate and say, okay, I turned 59.5 in May. All right? So the last 7 months, I can exclude that income. The first 5, it's still taxable in New York. Okay? So those are where we do that, and that's why those boxes are checked. All right? Okay? So back to our 1099-R, we have all of our information in there. All right? So we can see what we have. Down here at the bottom, there's a little sheet, a little worksheet, that if we have things where we maybe will be excluding this. Okay? You can see some of the different things that would exclude some of those things from different parts. The best one that we see up there, amount rolled over. May be the case that up in our code, or in our box 7, it was not coded G because we did a 60-day. So that's where we would put that in that box on line 1 to say that this was rolled over into another qualified account. Okay. All right. Okay. Now, we're going to get to his page 125 is the blue and the green of the railroad. Okay. Now, let's go back to our 1040, page 1. Remember we said that the blue is handled like the pink. Boys and girls together, Social Security. So if we go down to line 20A, okay, and we go in there to that box, light it up, hit F9, we have a worksheet for our Social Security and other income. Worksheet number 1. Here we are inside that worksheet. We can skip the first, that's where you would put in for scholarships or household employees. But you can see on the second one, all right, we have a little section that we have for Social Security, taxpayer, and the spouse. Okay, so we have that within that, all right? So this is where we're going to enter that information, all right? Now, if you note, you can see the little descriptions here. Top one, Social Security, that's the pink. Railroad Tier 1, okay, that's the blue, all right? Like I said, boys and girls together, all right? So that's where we're going to handle that, all right? So in this case, on our blue one up there, we go in there and it says Railroad Tier 1 received this year, okay? And as we look at box 5, it says net Social Security equivalent benefit portion of Tier 1 paid in the tax year, okay? So we're going to put that in that box, all right? And we have $14,121, okay? If we look on there also in box 11, it says Medicare premium, so we would have to put that in there. We'll talk about where that goes when we get into itemized deductions. And then it shows that there was some tax withheld, okay? So you can see there, I've entered it. Very similar to what you're going to do for your Social Security, the pink box ones and the problems. The only difference would be instead of having it on the one that says railroad, you'd move it up to the Social Security box up here at the top, and you'd put it in there. Pink and blue, boys and girls together, okay? All right. Hold on. We had a question about entering gross or net. It's always going to be the gross, okay? It's always going to be the gross, all right? So you're going to enter it before any tax or any Medicare is withheld, all right? Okay. All right, so we have that. Now, we're going to the green one, okay? I'm going to show you a little navigation shortcut here. The green one, as we said, it ends in the number 1099R. So I'm going to go over my 1099R I've already entered, and I'm going to go up here to the top, okay? So I'm going to use my little shortcut up here. And if you look up here, whoops, hold on one second, sorry. Up here at the top, okay, little thing that says copy, all right? So the little red box up there, you can see where it says copy. So I'm going to click on that, and what it did is give me another 1099R, okay? Again, for the taxpayer, address. We're going to put in the EIN number, and it's kind of small print there. It says payer's federal identifying number, but it's there on the green one. All right, so it goes in there. This is for the railroad retirement, okay? Now, let's take a look at the box. Box 1, gross, or in parentheses it says RRB line 7, okay? So if we look at RRB line 7, there's the total gross paid, all right? So we have 9,557.25, okay? All right. Taxable amount, we're going to talk about that in a second. As it says in the reading, we're going to code this as 7. It's a normal distribution. Box 4, it shows there in box 9 on the green, but box 4, we're going to have $250 withheld, okay? Now, as we saw in the reading, we have to determine the taxable amount, all right? So what we're going to do is we're going to go down below, and you can see we're going to use our simplified method. So at the bottom of the 1099R in the software, here's where we're going to see the simplified method in action. All right, this is where we would use that. Okay. All right, so we have cost in the plan at the annuity start date. Okay, and it helps us out. That is on the RRB line 3, okay? So we put that number in there from the RRB, the green section, okay? We put that in there. Now, the next one, check age of primary annuitant at annuity start date. If you remember, in the bullet points, it says Ralph retired from the railroad on June 4th, 2012. He was 65 when he started receiving the retirement. So here we are. We're going to check our little box that says he was between 61 and 65. All right. The next time that bullet point says he received his benefits for the entire year of 2016. So we're going to put 12 months. Okay. All right. And it is now calculated the remaining and the taxable portion. Okay. So let's go back to our 1040 page 1. Okay. So we can see here that we have our IRA distribution. We can see that distribution from his railroad pension. And then from using our simplified method, it is carried over to show his taxable portion that's in this column. All right. And you can see right here all the different numbers we put in. Okay. So if you look right in here in this section, we'll kind of talk about it for a second here. Okay. We can see his IRA of $982. We can see his distribution and the taxable portion of his pension. We can see his Social Security and the taxable portion. Remember, I talked about the fact that Social Security can be up to 85% taxable. Basically, what happens is everything above line 20, so everything right above here, will determine what is taxable of your Social Security. This is where when I have clients that are asking me, hey, you know, besides our normal distribution from our retirement account, we're going to take an extra $10,000 and take a vacation or buy a new car. Well, I inform them we have to be careful because it might make for more taxable income and maybe a different tax bracket. Also, it could result in making more of your Social Security taxable that they may not have withholding. So sometimes it can be kind of a double whammy as far as taking that money out. Okay. All right. Okay. Okay, Matt asked about that. As I just said there, you can see on the form, it did go somewhere for us because it shows up right here. It took and carried forward what we needed to onto the 1040. You can see that, and using the simplified method, that carried that forward for us. Okay, based on what we inputted from our information in the simplified method. Okay. All right. Okay. So that's how the railroad is handled. Again, I touched a little bit. I wanted to use that one too because the pink box ones will be handled pretty much the same way, okay? Because they will be on there with the Social Security line. So if you have those, they would be handled the same way. All right. If we take a look on the state side, we talked about the Social Security taxable portion and the exemption from that income. All right. Now, let's address the thing about married filing separate, because we'll talk about this when we get to the next chapter with itemized deductions. You can see here on 39B, it says if you are married filing separate and your spouse itemizes, or you are a dual status alien, check here, okay? In a married filing separate situation, if one itemizes, the other must itemize too, all right? So in this case, we found out that Bernice has already filed. She takes the standard. So we can go in there, check it, uncheck it, and hit F3 to get rid of that, okay? So basically, he can still get the standard deduction. If it was the case in our bullet that said that she itemized, we would check that box. So if you look right now, what has happened is he is getting right here the standard deduction for his age, okay, as a single person. All right. If it were the case that she itemized, he drops and we have to start from almost basically zero, and we probably have to itemize and find out, is he paying any property taxes? Does he have any mortgage interest, any medical, any charitable contributions, things like that, to see how far we can get. Because if she itemizes, so must the other half of the married filing separate. But as I said in this one, okay, she is separate on this. There's a question about, does the divorce have to be finalized to be considered single? They're doing married filings separate, okay? Basically, it's the same as the single, but because the divorce has not been finalized, they are just separated, they do married filings separate, okay? Where that considered unmarried comes into play is where there might be a qualifying child so that we can use the head of household status. But if there's just two people like this with retirees, then they do married filings separate, okay? All right. Any other questions on the problem? Again, I kind of picked that one because I wanted to show you the railroad, but there's also some things in there about Social Security, okay? Because you can see where that line, that's the pink boxes. Some of the other problems that you have will have that on there. All right. Okay. All right, since we don't have any questions there, we'll go on and we'll get ready to start into chapter number 10. We're going to start talking about itemized deductions. And like I said, we're going to cover two chapters here pretty quick. The thing with the itemized deductions, this is the one that most of the people already know, Schedule A, from their tax returns. If they're doing a long form, they're probably doing this, especially if you're a New York resident with property tax. If you want to go on to YouTube where the videos are, there's a couple great radio shows that Esther's done. We won't spend any time this morning on it, but there's a couple great radio shows that she's done regarding the impact of the new tax laws on individuals, as far as especially in New York State. Okay. Also, she's done several interviews locally with TV. If you go to our Facebook page, I've posted the videos there that you can watch where she's discussing how this is really working, how this new tax plan really works. Okay. All right, so we're going to take about 5 minutes before we start and go through all the chapter here on itemized deductions. If you have any questions about anything that's covered so far, just put it in the chat. We'll be right back, okay? Okay, welcome back, everybody. We're going to continue on into Chapter 10, where we're going to talk about itemized deductions. Okay. Again, this is a chapter where people are a lot more familiar with, but we're going to try to take it a step farther. So, in a case with a client, if you remember, we talked in one chapter about the difference between deductions and credits and how it impacts their refund or their tax liability. A lot of things that we've talked about so far have been based on the income. We've talked about our non-refundable, that's our Pac-Man credits, and our refundable, our Energizer Bunny credits. Okay, Pac-Man, they eat it up till the tax bill's gone. Refundable, they keep going on no matter what tax bill we have or not. Okay, we're farther up on the return on this. We're kind of at the top of page 2 of the 1040, and we're looking at the things that we're going to adjust the income or deduct income for prior to calculating tax. Okay, so these are a deduction, not a credit, but a deduction. Okay, you can see here we're talking about the easy way to take the standard deduction. We'll talk about what that is, and then we'll talk about the different characteristics of itemized deductions. All right, as you can see down here at the bottom, we're going to talk about our objectives here. We have that we're going to determine when a standard deduction and when the increases. We're going to talk about how advantageous it is for a taxpayer to itemize. This chapter is going to talk about the medical and dental, tax and interest, and charitable, okay, and how these are put on to the Schedule A. All right. Standard deduction. If you remember, we talked about this briefly when we talked about the filing threshold. All right, that filing threshold, if you take the standard deduction and the exemption and add those together, typically that's where you're going to see your filing threshold, whether somebody needs to do a return or not. Because once their income gets to this point, if it is at or less than their standard deduction and their exemptions, they have no taxable income. They may not have to file unless they have withholding. Okay, we can see on here we have for the single $6,300, married filing joint $12,600, had a household $9,300. Okay, so this is our standard deduction. If we're not going to itemize, maybe we don't own a home or we don't have enough, we would just take the standard deduction to be able to subtract that from our income before our exemptions and figuring our taxable income. All right. Now down here it talks about some increases that would be happening in the standard deduction. If you remember on our main info sheet, it talks, excuse me, it talks about we have to fill out their age, and then there's a section that we can check if they were blind or disabled. Okay, age and those characteristics would be something that would increase the standard deduction. So you can see in the table down here at the bottom that it takes into account the number of those boxes that are checked. Okay, so at the top of the next page, we can see where that would come into play at the top of page 4 of the 1040, excuse me, page 2 of the 1040. Okay, so that's where that standard deduction may be increased. All right, so again, standard deduction is a pretty simple procedure as far as it. You just determine what that number should be based on the information you put in about the taxpayer and or their spouse. Okay, itemized deductions, same line as the standard, what it's calculated as, but this is where we're going to maybe break it down. We're going to take a look at some things that are actual out-of-pocket money that we spent or was not reimbursed to us or anything like that, that would we be able to add in. We're going to talk about out-of-pocket medical and dental, state and local income taxes that we've paid, or real estate taxes, mortgage interest, what we gave to charity. Okay? Medical and dental, all right? One thing I tell everybody in my class, and I'm going to kind of use it here, and I'm going to kind of hold it up here, but in the offices, there's either a quick finder or a tax book, okay? These are both great. They kind of work in tandem with your textbook. They have some great sections. But as far as when I talk about the itemized deductions, the medical, I love to use the Quick Finder. Medical expenses are those things that we have, whether it be medical, dental, vision, and some other characteristics that we pay out of pocket, okay? Now, the one thing about it is on the itemized deductions, we have a threshold, as I like to call it, okay? We have a number that we have to reach before it counts, all right? Example, if I have an adjusted gross income on my tax return of $100,000, as you can see in that paragraph, I'm under 65. I have to get to 10% of my income before I can use my medical dollars. So my threshold at 10% would be $10,000. If I have $10,005 of medical expenses, I can only use $5, okay? So just because we reach the threshold doesn't mean we get to use the whole amount. The meter starts to run after we reach that 10% threshold, and then we start using that money, so I'd only have that $5. Well, a lot of times when you're talking with a client and they want to itemize their medical, the first question would be, you know, what is 10% of their adjusted gross income? Did they meet that or did they exceed that? Okay, so we have that in here as a threshold. And unless somebody has a major medical event, or as we'll talk later about the nursing home, it's very difficult to get to that threshold. Okay, so it's a difficult one. Anybody over 65 gets to use 7.5%. That used to be the old formula for everybody. That actually, some of that changed with the Affordable Care Act when it was implemented. All right. Talks about what medical expenses are. Again, out of pocket. Okay, things you paid for, not things that the insurance paid for, but things you paid for. Okay. Now, you have to take it when it was paid. All right. Remember, we're on a cash basis, so we have to take when the money exchanged hands. All right. Now, what can be included in these? Medical premiums. If you remember, I talked about the fact that on the Schedule A, and when we get into the problem, I'll show you, but we talked about that when we entered into Social Security, we put Medicare on that little worksheet, Worksheet 1. Well, that carries over to Schedule A because, as you can see, those premiums that you pay out of your Social Security, you can carry over and deduct that, okay, as long as they weren't paid by somebody else. Again, everything on the medical has to be out of pocket, not paid by somebody else or reimbursed through your insurance, okay? Long-term care insurance, all right? Don't see as much of these as you used to because long-term care insurance has become very, very expensive, okay? You can see that it is limited, and we'll show that when we get into the problem again, how that works as far as that. But, you know, some people pay $10,000, $12,000, $15,000 a year in long-term care insurance premiums to cover them should they end up in a nursing home. Well, you can see here that there's a limitation as to what they can take, all right? Now, the one thing about long-term care insurance is that it is a non-refundable credit also on the New York side. What that means is in New York, that insurance that you pay for can be a credit that will eat up your tax bill until it's done, all right? So it is a beneficial thing on the state side. All right. Now, here's this chart. Qualifying medical, dental, and I always tell everybody as I'm wearing glasses here, don't forget vision, all right? But those things are in there, and it talks about that they're doctor's visits, tests, hospitals, prescriptions, things like that, okay? However, you can see in this chart, it talks about a lot of different things, all right? So we can talk about the fact that, all right, air conditioning. Air conditioning, a device installed in a room for a relief from allergies or other respiratory ailments. So you can deduct your air conditioner, okay? Again, one that's on here that everybody, I never fails, and I always laugh when I'm talking about dependents on the return. They'll say, no, but we got 3 dogs. Can we put them on there? And I said, sure. Are those dogs for a condition? Are they somebody in the house is blind? Or is somebody having an anxiety disorder that's diagnosed by a doctor? Okay, as it says here, for guide dogs or other animals to be used by visually impaired, hearing impaired, or other physically disabled persons. If you've ever been in a grocery store, you see those people with the little dogs in their purses. Those may be dogs that are called anxiety dogs. And if they have an anxiety disorder that they cannot go in public unless they have this dog so that they can function, it may be the case that qualifies if it's something that's a disorder that the doctor says that they have. You can include costs such as food, grooming, and veterinary care incurred to maintain the animal's health and vitality so they may perform their duties. So, back to the dependency. Yeah, you can't claim them as a dependent, but you can put them on the tax return if that's the case that they fall in there. Okay? Talks about different things. Believe it or not, it has in here dance lessons for any of you that like to dance. You cannot deduct those, even if the doctor tells you that you need to start dancing or something to lose weight. Okay? But there's a lot of different things that are in there that have to do with the things that are the well-being of the body, as it talks about. Okay? So, what I want you to always do when you have medical, think outside the box. And it's never hurts that when you get to this point with medical, if somebody has a major medical event or condition in the household, start thinking outside the box. What things could relate to that? What things has the doctor prescribed? Okay? You know, maybe the case that you have somebody put in a hot tub. Well, if that hot tub, all right, was put in for the case that it had to be done because of the health of the person, and the doctor said you need to have this type of hot tub at home to treat this disorder, well, we might be able to pursue that. We'd have to see. Okay, so again, always think outside the box. All right, one way you can do that, and a lot of people don't think about this, is capital expenses. All right, I have a client. She's now a client of mine, I should say. She came to me with a different issue, but as I was looking through a return in our discussions, she was, you know, had things that she needed to do and take care of when she was setting up for her retirement, and it came up that her husband had MS, and she basically had to do several capital improvements to her house to be able to have her husband live at home. They basically added a wing. The hallways were wider. Special bathroom, a ramp to get in the house, the little track to be able to move him from room to room. Okay? All these things that you can see here, those are things that are medical expenses that could be deducted in the year that they were spent. Okay? All right? So always make sure that you double check. All right? It has that information that you do and that calculation. Lodging. Buffalo area, sometimes people are referred to the Cleveland Clinic. So it may be the case that while you're away from home, you have expenses. These things may be deductible as medical expenses. Okay? The nursing home. Okay? Again, I'm going to kind of read what it says here in my little quick finder. It says the nursing home, entire cost for medical care, including meals and lodging, if the main reason for being in the home is to obtain medical care. If not entering the home primarily to obtain medical care, only the portion of the fee actually spent on medical treatment is deductible. Okay? If the care is qualified long-term care, make sure that the insurance isn't covering it where they're being reimbursed. Okay? So basically what I'm saying is if somebody is in that nursing home for a medical condition, you know, you get the itemized bill from the nursing home, some of that the amount, and it's not inexpensive to have somebody in a nursing home, so that may be the case that some of that can be deducted as medical income. Okay, all right. Talks about several other examples in here. Okay, again, talks about what can be deducted as expenses. When we get in the problem, we'll talk about this. But just remember, we can never double dip, okay? If it's the case that your health insurance is on pre-tax dollars, which means is that on your W-2, they've taken and withdrawn what you've paid for your employer or your health insurance is deducted before they calculate your box 1 on the W-2 for taxable income. We'll have to make sure on that, okay? And again, same thing, premium tax credit. We'll talk about it in 16. But those are things that you cannot do. Also, even though you paid it out of pocket through a health savings account, again, those cannot be deducted, okay? Reason that is, we're putting in, we've already taken the tax advantage with the money we put into the health savings account. All right. Okay. And we talked about the threshold, the 10% and the 7.5%. Okay. We're going to move on to taxes paid. All right. So if I have taxes that I paid, this is things, and again, we'll show this when we get into our problem. We start looking at our Schedule A and how things go in there. But the things that I pay, I can deduct as far as taxes paid. All right. Sales tax is kind of disappearing. It used to be one that, you know, I always called everybody the shoebox person. That would be the person that came in with every receipt to show every dollar of sales tax they paid. A lot of times when you added that up, it wasn't as good as the other state tax. And the other state tax you can deduct is the tax that's withheld from your pay. Okay. Other taxes, real estate taxes, property taxes. And even those that are in New York, they see that little $31.20 that's taken out for New York State disability. That is deductible also as taxes paid. Again, we'll see these kind of listed out when we get into the problem. We'll see where these go. Okay. But taxes paid, you can deduct. As I said, income tax, when you start talking about income tax, those things that show up on your 1099s, anything that maybe is withheld from your W-2, your 1099-R, your unemployment state withholding, things like that, anything that shows up as that can be withheld, okay? Also, sometimes people pay estimated taxes to the state. In the case of retirees that we talked about in the last chapter, sometimes they're not able to exclude their income like they should, so they have to take and be able to pay tax timely and quarterly. That last payment that is typically not due till mid-January of outside the tax year, if you make that payment before the end of December, you can use it on your itemized deductions, okay? So those are all things that are there for that. Now, remember, taxes paid, we're on a cash basis, all right? So if it's property taxes that we're talking about, they have to be paid, okay? We're not going to talk about the sales tax. We really don't see that. It's there for your reference to kind of talk about what those would be and sales tax exemptions. Like I said, it's one of those ones that is not going to be on the 17 as far as we know right now, but it might have a 9 lives thing and come back. But we can we'll talk about that when we get into the further when we talk about 17 tax laws. A little table here that talks about the codes that you would put on the sales tax worksheet. Again, I'll show you that in action when we get into the problem that we do with the Schedule A. Okay? Real estate taxes. We pay taxes on our house, our land, whatever it may be, our home. Okay? We can deduct that as far as it's imposed on the taxpayer, on the person that is on the tax return. All right? One thing with property taxes, when the year that you buy the house, you want to make sure you take a look at that closing statement or that HUD-1, because there may be things in the closing where you paid some property taxes also. So we got to make sure that we take that into account. All right. When we get into the actual problem with the Schedule A, we'll kind of see where we'll have the information about things that we might have to divide the sales tax, or excuse me, the real estate taxes, because of a home office or we're own a duplex. So we'll talk about that, okay? You cannot deduct delinquent taxes, okay? All right? Delinquent taxes are unpaid taxes that were imposed on the seller from an earlier tax year. If the buyer agreed to pay delinquent taxes when they bought the home, they cannot deduct them. They're treated as part of the cost basis of the home, okay? So past taxes, okay? That's how those are handled. All right. Okay. Personal property taxes, again, charged on personal property based on the value of personal property or charged on a yearly basis, even collected more than once a year. Our school taxes, things like that. Or we own a second home. Okay. Interest paid kind of mirrors, because when we think about mortgage, or excuse me, about property taxes, we typically mirror that with our mortgage interest. Okay. So those are where we have those. Home mortgage interest, all right, is things that can be paid on a loan that we have, all right. You cannot deduct personal loans for credit card interest. However, home equity loans, you can because it's tied to the house, okay? So that's where we have that, all right? So as it says here, the mortgage is a secured debt on a qualified home in which the taxpayer has an ownership interest. That's where we can take that, okay? All right. You can also deduct points, all right? So if those points reported on Form 1098, that's where we see our mortgage interest. You can deduct those, and they're limited on Schedule A. Some of the points will phase out depending on the household's income, okay? So you have to make sure on that, all right? PMI, mortgage insurance premiums, okay? So as it says here, enter the qualified mortgage insurance premiums paid under a mortgage insurance contract issued after December 31st, 2016, okay? So if we have mortgage insurance premiums, shows up on box 4 of the 1098, we can take that on there also. All right. Here we talk about interest that cannot be deducted. Some interest payments aren't deductible. Certain expenses similar to interest also aren't deductible. Personal interest or personal loans, service charges, annual fees for credit cards, loan fees, credit investigation fees, mortgage insurance premiums and VA funding fees, interest to purchase or carry tax-exempt securities. So these are things that are not deductible as interest. Okay. All right, a little bit of an information there with the Schedule A. We have a 1098 showing information and where that would go within those. Okay. All right, gifts to charity. All right, charitable contributions. Always one that everybody, when we do tax returns for them, they will kind of talk about the fact that they say, well, just give me whatever, I don't want to set up a red flag. Well, gifts to charity are something they're always going to scrutinize, okay? Especially if it's something that looks out of the ordinary or is an exceptional amount of what the income is showing up on the return, all right? But basically what you have to know about gifts to charity is you have to give them without expecting anything in return, all right? If I'm buying raffle tickets at the Volunteer Firemen with the expectation that I could win a side of beef, then it's not really deductible, okay? If I go and I give a basket, a charitable contribution at a Chinese auction, okay, and I don't buy any tickets to participate, I'm not expecting anything in return. Well, but if I give that basket and they said, because you're a volunteer, well, here's 2 free tickets to the next local baseball game, well, I've got something in return, okay? So, again, using that mindset that is it really truly just given without anything in return, okay? That's kind of talking about something that's cash or goods, all right? Non-cash, one thing that comes to mind, and I always use the example, is I coach my son's soccer team, okay? So I am able to write off that time as a soccer coach. No, because if my son is on the team, then I probably would be there anyway, okay? So I can't do anything with my mileage. Equally, I cannot say, well, I'm taking 2 hours off work, and that time off work, I would normally have made $100 an hour, and I'm going to take that as a deduction. No, you can't do that. You can't put value on your time, okay? If it's the case that I'm a Boy Scout leader and I do not have any children participating, then that's different. My uniform, my mileage, that may qualify, okay? So you always want to make sure that, again, you take that rule of things that what is expected or anything in value in return, okay? Now, the other thing that's on here is it talks about it must be to a qualified charitable organization. Again, you have to kind of look that up. Do they fall under that 501c? You know, are they an organization? People always ask me, I gave money to somebody on a GoFundMe page. Well, if it's just raising money for somebody and they're not a charitable organization, you have to be careful. because even though you did not expect anything in return, if they don't qualify as an organization that would be something that they could take charitable contributions, then you have to really look at that. Okay? All right. Talks here on a couple things where it's a good example of charitable contributions. You know, the ones on the left are pretty straightforward. The ones on the right, again, we talked about social and sports clubs, you know, your dues and stuff for charitable contributions, all right? Groups that are run for personal profit, again, kind of talking about a GoFundMe type thing, all right? And obviously political groups or candidates for public office. Cost of raffle, bingo, or lottery tickets, okay? Again, when we have something where we paid and we gave it in a charitable manner, but we have an expectation of something in return, we cannot be doing that. And as it says at the bottom, even though you're making a charitable contribution, you can't put a value on your blood given to a blood bank, all right? Talks about volunteer work. I talked about that a little bit, all right? Okay. When we give cash contributions for charity, we have to make sure that we understand that those cash contributions, we have to do record keeping. We must do good record keeping, all right? A lot of times, you know, somebody, you know, the volunteer firemen are holding their boot at the stoplight, we put some money in there. Well, we have to have some record of it, okay? You know, round up the receipt at the cash register. They say, oh, would you like to round your receipt up to the next whole $5 to give it to something for children, homeless people or whatever. You know, make sure that you have that. Make sure, you know, most people like to write a check, get that canceled check, okay? Something that says that they gave to an organization. A lot of times with cash things, because of the way 501Cs work, they will be sending you a letter that says, thank you for your contribution, all right? Churches, they're very good about this also because they tend to give that statement at the end of the year, here's what your tithe or your giving was, okay? Now, non-cash contributions, all right? Again, we've kind of been talking about cash, non-cash. The best example I use for everybody is mom and or dad passed away or moved out of their home and you're getting ready to empty it. Well, all those things that are in there that nobody wants that you're going to give to charity, you have to determine a value, okay? And if it's more than $500, we're going to have to do a due diligence. We're going to have to do a form, an A283 form, to be able to itemize that. And we'll see that when we get into the problem that we're going to do, all right? The thing about non-cash contributions is we kind of get back in where we start talking about fair market value, okay? We must have something that determines the value of that, all right? On page 1045 of your book, it talks about a little thing from the Goodwill that the IRS has kind of endorsed to say that this is a good guideline for things, all right? We're going to use t-shirts as an example for non-cash contributions, all right? So if I have my t-shirts here, it says if I give away my t-shirt, I can get $1 to $6 for it, okay? Well, how do I determine that? Well, let's think about it. If it's a t-shirt that's worth $1, it's probably something that you're going to have at a garage sale that somebody might buy to wax their car. If it's something that you give and a thrift store is going to sell for $6, then that's the fair market value. It's a nicer shirt, okay? So you have to determine what that fair market value is of that shirt, okay? And that's how you determine that value for non-cash contributions, all right? As I said, if you get things over $500, you have to here do the 8283. Excuse me. If you note in the middle, we have a little section that talks about the car, okay? If you give a car that you run into the ground and you've driven and you've decided I'm getting a new car, this isn't worth trading, I'm just going to give it to charity and write it off of my taxes. Well, that charity is going to give you a 1098-C and you have to put the VIN number on there, okay? All right. And again, there's the table. If you'll note here too, the other thing I tell everybody is make sure you realize when you give those old cell phones, computers, and stuff like that, they have a pretty good fair market value. The reason being is most of the time those organizations are selling them to somebody to harvest the precious metals, okay? The gold and the silver or the platinum that may be inside of them, all right? So make sure that you know that those contributions, when you give them, do have a market value, okay? All right. Okay. So that's hitting chapter 10. Again, we'll talk about more of these things when we get into the worksheet and doing the problem. All right. Just going to take a couple moments. We'll do chapter 11 and the problem to finish up today. And again, if you got any questions to this point, just type it in the chat. Okay, so we're going to finish up here with the itemized deductions, part 2, chapter 11. All right. In this chapter, we're going to talk about some things that you don't see often. We have our objectives here, but these are areas that we want to talk about. Most all of the ones that you're going to see on somebody's tax return is going to come from that first chapter, chapter 10, where it comes in with medical, property taxes, real estate taxes, taxes paid, interest, charitable contributions. But there are other things that are on the Schedule A that somebody might like to itemize and deduct, okay? We're going to talk briefly about casualty and theft losses. Don't see a lot of that. We may see more this year just because the natural disasters that have been happening. But you know, if it's the case that that loss or that theft was covered by insurance, then it may be the case that they don't get to the threshold to be able to use it on their itemized. Okay. Net operating loss we'll come back to. Again, I like to use that when we see it in action with our business so that we can talk about that. Okay. We're going to talk about how to report somebody that is a W-2 employee and the expenses are unreimbursed expenses, as I should say, that they have. Work-related education expenses. Some of these and things that are subject to a 2%. The 2%, very similar to what we saw with the medical, with the 10%, 2% threshold. We have to get to that before we can use those dollars. Okay, so we'll talk about different things within that. All right. Again, if you have any questions, throw them in the chat there, okay? Casualty and theft losses. Again, very good reading for you. You know, those are losses that we may have that we can say that we're not covered by insurance, okay? All right. So as it says here, caution. If the property is covered by insurance, an insurance claim for reimbursement must be filed in a timely manner. Otherwise, a casualty or theft loss cannot be claimed. However, the part of the loss that isn't covered by insurance is still deductible. So as we say there, and as you read through here, you can kind of understand what those losses would be. As you read through this too, like I said, we don't see a lot of this in action, okay? I guess if you've been a victim of a Ponzi scheme, you can talk about that if you have that in your background or things that are there, okay? All right. And it's also in a category where there's a threshold, all right? A lot of this, when we see the form in action that we would see has a threshold that before you have to get to a certain amount before it would actually help you on your itemized deductions, okay? All right. Okay. Here's the form that we use for this, 4684 casualties and thefts. Okay, so you can see on there, you have to put on there the description of the property as far as what each thing that was lost or damaged. And then you have different things that you have to go through and calculate to see that if you meet the criteria for that to go on to the return. All right. There is one here that shows the form in how it works. So make sure that you send that, read that information so you can see how that works, where it has the instance with the car, and make sure you understand how that works. Okay. Again, if I do 1 or 2 in a year, that's a lot. All right. Net operating loss. Again, I'm going to come back to that. We'll talk about the net operating loss when we talk about Schedule C's in the business. It's much easier to see what we do with that when we see that. It is part of the Schedule A. However, we need to see where it's generated and that so that we can understand what that net operating loss is doing. So we'll come back to this when we talk about the Schedule C. Okay. The big thing I want to talk about in this chapter is employee business expenses. Those are expenses for somebody that is a W-2 employee or a statutory employee. Okay. And new introductions of words that we've heard before, but employees may be able to deduct ordinary and necessary business-related expenses for travel, entertainment, gifts, and transportation. Okay? Ordinary is one that is common and accepted for their trade or business. Necessary is one that is helpful and appropriate for their business. Okay? All right? An expense does not have to be required to be considered necessary. All right? Again, apologize about the cold, so hope everybody hears me okay. On the Schedule A, inside of it, there's a little form that we'll use. It's called a 2106. When we do the problem that we're going to do out of the workbook, we'll see that, but we'll kind of talk about the different things that make up these ordinary and necessary business-related expenses. Okay? Travel expenses may be deductible when the employee is traveling away from their tax home for their business, profession, or job. Okay? When its duties required to be away from the general area of their tax home, and they sleep or rest is needed to meet the demands of work a while away from home. That typically, when you hear that second one, the first thing that comes to mind is an over-the-road trucker. They do on there on a 2106, if they're paid as a W-2 employee by their trucking company, they may be able to write off a per diem. The IRS, again, in the quick finder that I showed you earlier, has a little table depending on where you've traveled to inside the continental United States that you could get a deduction of a per diem for the food and lodging if you are an over-the-road trucker because of your requirements to rest and a certain amount of sleep. Okay? So, again, travel expenses, you must be away from your tax home. Okay? All right? You have to talk about, is it temporary? Is it, are you there? Prime example, it says here about indefinite assignment or job. If an assignment or job is indefinite, 1 year or more or to be expected, the location of the assignment becomes a new tax home and the employee cannot deduct their travel expenses. I guess the first one that comes to mind here, if it's somebody now that has been relocated temporarily to parts of Texas to help with the hurricane recovery. Well, if they're there and they're living there, and it may be more than a year that they're doing that, or expected to be more than a year, well, that becomes their new tax home, okay? So then those things change as far as what you can deduct, all right? Meals can be deducted in either following situations. It is necessary to stop for substantial sleep or rest. Again, talking about your over-the-road trucker, your per diems, okay? Or the meal is a business-related entertainment. Discussed later, okay? Generally, only half of it. Basically, what the IRS is saying with meals is that you can take half of it. So if I'm out with somebody for dinner discussing business, I can only deduct half of it. The IRS has deemed that you must eat too, okay? So in order to survive, you must eat, so you cannot write off the food that is for yourself. All right? Okay. We talk about entertainment expenses. All right. There's that limitation again when we talk about meals and entertainment, because we cannot write off the personal half, basically. All right. Gift expenses, okay? Deductions for business-related gifts are limited to $25 per person per year. This includes both direct and indirect, okay? Exceptions to the 25 limit include an item that costs $4 or less, all right? Basically, what it's saying is that you can give everybody that $25 gift card to each of your, co-workers or whatever, and you can deduct that. However, if it's over $25, then only the first $25 is deductible, okay? Transportation, again, we're going to see this when we get into the problem that we're going to do, but we talk about transportation expenses. Those are the deductions for business-related expenses when they're away from home. You can include airfare, rail, bus, taxi, but again, you can only deduct what is not reimbursed by your employer, okay? Great little chart here that talks about when transportation is deductible, because you have to understand that some things are considered your commute. So if you're going from your home to your primary job, then that's not deductible, okay? However, if after you've gotten to your primary job, you're working nights to make some extra money during the holidays, that travel from your second job, or from your primary job to your second job, is deductible, but not going home, okay? So really nothing where you're returning to your tax home is deductible, okay? But this is a great little flow chart. It talks about their home, okay? We go to our regular main home. If we go to a temporary location, or we have a second job, all right? Those things are always deductible, okay? Car expenses, again, we'll talk about this a lot more in detail when we get into the Schedule C, but for right now, we want to take and look at the things that are ordinary and necessary for the car. You have two ways to do it. You can do it as a mileage rate at 53.5 cents, okay? Or you can do the actual, where you keep track of every gallon of gas, every oil change, everything that you do to that car, license, depreciation, things like that, all right? 99% of the time, taking the mileage is a much better deal, okay? And once you've determined one method, you must stay there. You can't go back and forth and see which one's the best for each year. Because if I've been using actual, but I have a year where I drove a whole bunch of miles out of ordinary, I can't say, well, this year I'm going to use the mileage because it's a better deal. No. Once you've determined that, you must stay with it, okay? For 2016, it's 54 cents. 17 is going to be 53.5 cents a mile. Again, pretty generous by the government, a standard rate, so that you don't have to keep every gallon of gas and everything that you do to your car, all right? So make sure that you keep track of that, all right? Talks about record keeping with those business expenses, okay? All right. Now, there's a thing here where it talks about unreimbursed employment-related expenses that do not require a Form 2106, okay? Union dues, tools and supplies not furnished by the employer to do a job. If you're a carpenter, a W-2, and there's things that you have to buy on your own, okay? Physical examinations required by the employer. Dues to professional organizations or professionals' magazine subscriptions, all right? Fees to an employment agency. The cost to look for a new job, okay, in your current occupation. So if I'm a nurse and I'm looking for a new job in nursing, I can deduct that, okay? Home office, some educational expenses, your business liability insurance, cost of teaching aids, supplies, and equipment. We'll talk about adjustments to income, the educators, but also, prime example, I have a client that out of her pocket, as part of her profession as the music and theater teacher at a school, she pays for a lot of the costumes for the annual musical out of her pocket. Those are things that we can do as work-related, okay? We'll see the 2106. These are different parts where it talks about the different lines as far as the mileage things, but we'll see that when we get into the problem, okay? All right. Work-related expenses, again, with education. It's going to be subject to our 2%. I'll show that when we get on the Schedule A. When we get into our problem, we get a little deeper into it. But again, there's a threshold on these expenses that we have to meet in order to deduct those. Okay? Tax prep. When you're being paid to do a tax return by somebody, we can deduct the tax preparation fees. Okay? So, again, subject to our 2% rule. All right? And then we kind of have some things that fall under miscellaneous here. Kind of one of those things, we have a line on a lot of forms, just like on the 1040, we have line 21 for other expenses. On the Schedule A, we're kind of saying, hey, these are other things that we can deduct, but they don't garner their own line, okay? The big one that comes in here that happens a lot is investment fees and expenses for advice, but not for seminars. A lot of times at the end of a 1099B that we talked about in capital gains, there is a little page that comes in at the very bottom. Says investment fees, advisory fees, things like that. Those are things that you can write off. Safety deposit boxes can also be on there. Okay. We have other deductions that are not subject to 2%. The biggest one that comes in here is our gambling losses. Okay. We talked about earlier on the W2G that you can put at the bottom of that, a place where you can put in up to and equal to the amount of winnings is losses. Well, this is where it carries over to the Schedule A. Okay. And again, some of these things that you see here are things that we'll talk about later, but things that would come over from other forms like K1s or other documents from other businesses or other matters that would come over that we can take as a personal deduction on our Schedule A. All right, and we have some non-deductible expenses, okay? There may be adoption expenses in there, all right? Club dues, you know, if you're joining the local country club, you cannot write off your club dues, all right? Fines and penalties, all right? So you can't write off that traffic and speeding ticket even though you were doing it for work, all right? You cannot write off your homeowners or renters insurance for your personal. We'll talk about differences with that when we get into Schedule E with rental income, but for right now, that personal, we cannot do that, okay? And again, a lot of people ask, oh, can I write off the new roof that I did? Well, we talked about the energy credit, but repairs, improvements on your personal residence are not things that are deductible expenses, okay? All right. We have here, there's a little threshold and limit on some of the things that we can take. There's a phase-out limitation that shows here as far as what the income, where we're limited on things we can take on our itemized deductions. All right. Okay. All right. So, we got a question here before we go to things. We have a question here where it says, if a senior citizen hires a health aide, is the wages paid to the health aide deductible? Okay, let me tell you what it says. And again, this is where I always like to go to the quick finder because it talks about it very specifically. All right. Okay, it says here, so we'll kind of read this what it says. Nursing care. Wages, employment taxes, and other amounts such as the attendant's meals paid for nursing service conducted with caring for a patient's condition, including extra rent or utilities for a larger apartment required to provide space for the nurse attendant. Non-deductible, personal and household services provided by an attendant or nursing services for a normal, healthy baby. Okay, so that we have basically what it's saying is that person there because that person has a condition that they have to have a nurse. If it's more of a sense that it's there for a companion, you're kind of stretching it just a little bit. Okay, does that make sense? Okay. And again, you know, that's always a way to think outside the box as far as that, that income. All right. So we are going to go into another problem. All right, so if you want to grab your workbook and go to actually chapter 11's problems, it's page 154 in your workbook, okay? We're going to do Timothy there. We're going to do his problem. And no, I didn't pick it out just because of the namesake. Give me 1 second here. Okay. All right, so we're going to do the problem here for Timothy. All right, so I have Timothy. Well, let's look at our bullet points here first, okay? So on page 154, it talks about the fact Timothy filed a Form 1040. Timothy and his ex-wife itemized last year on their 215 tax return. They received a refund of $2. Timothy just went through a divorce and was finalized in December. So he's basically divorced one day, divorced the whole year. If he gets a refund, he'd like to go in his checking account. If he owes, he'd like to write a check. He won $500 on a scratch-off ticket. All right. We'll have to see if he has a W-2G. All right. He had health insurance the whole year. And then it shows he had all these expenses. All right. He wants to know if he could file a Form 1040. So we're looking at things that may or may not be on his Schedule A. Okay. So let's get all of Timothy's information in here. All right, so we have that all in here. All right, he has his Y-Mail account. As I've said in the past, it's always good to get that in because you need to make sure there's somebody, especially right now, we're going through that, as I've said, with the FAFSAs, people asking for copies of the returns to be emailed to either themselves or a college institution. Okay. All right. Okay. And he is a security guard. All right. As soon as I see security guard, the red light should go off. Probably start talking about things that he may have, uniforms, things that he has to do. Okay. Obviously, he's going to be filing single this year. Not married filing separate, not married filing joint. His divorce has been finalized. Okay. We have no dependents on the return. He was a New York resident the entire year. All right, so we have that. As we said, he wanted the money if he has a refund. He would like it to go into his bank account. All right, get his pen in there. Okay. So I've completed his main info sheet. As we go back there, we did see that he had health insurance all year long. So we'll take care of his health insurance. All right. First bullet point. He itemized last year. okay? And there was a $2 refund. So he has half of it because the other half would be with his wife, okay? All right. So we'll come back to all the bullet points there. First thing we're going to do is we're going to get his W-2 in there, all right? So again, go to the 1040 line 7, or I can go right over here on my tree, have my W-2. I'm going to check the taxpayer's box. All right, the address looks good on his W-2. All right, put in the employer number for this. All right, he works at Bank Security Systems. We have his wages, his withholding, okay. In box 14, we have something that says charity, okay. We're going to want to remember that, all right, because he gives charity. Maybe in the case that they have an automatic payroll withdrawal to the United Way or something like that. A lot of times it's instead of saying charity, it'll say UA, okay? Nothing in box 12, and then we have a state withholding, all right? Okay. Now, because we said he itemized last year, our Schedule A popped up on our tree on the left. So here's our Schedule A that we're going to use, okay? If we remember, we kind of gone through of them, but we went right through medical and dental, taxes paid, interest, charity, losses, job expenses, and then those other miscellaneous deductions, okay? So we've gone through all the categories here. Probably going to have things that ends up a little bit everywhere. Remember, I said I wanted you to remember a note about your charity that was on there. It doesn't carry over, so we're going to have to put it on there, okay? So I'm going to go to my charity section. I'm going to light up one of my little boxes here. Hit F9. I have a little detailed worksheet that helps me inside my Schedule A, all right? At the top of this worksheet, detail worksheet, is medical. Well, we're going to come back to that. As you can see on page 154 of the workbook, he has several things listed. But we're going to scroll down here, and here's our cash contributions. So you can see right here that we have cash contributions, and a little area to put those in, okay? So we're going to take care of that W-2 before we forget. So I'm going to say W-2 charity, all right? And I'm going to put in there that he gave $532.81. Okay, so I can put that in there. This little worksheet, now, if I go back to my Schedule A, you can see it carried over, and now I have information on that Schedule A towards my itemized deductions. All right? Just because I've started to do a Schedule A, and now I have an itemized deduction total. Oh, hold on, I've got a question here. As far as the 50%, that is if there's a limitation, okay? If you take a look on there, if we end up where his contributions to charity exceed 20% of his AGI, then we have to have them fall into categories where they're 50 and 30%, okay? He's not going to have things in excess of $7,700. What that basically is it creates limitations on the amount of the charity that you can take, okay, because of your income, all right? For right now, everything that we're going to do, you're going to put in the 50%, okay? But it just creates a limitation, all right? Okay. The other thing I'm going to point out real quick, here's those charitable miles, 14 cents a mile that we're working there, okay? So if I'm volunteering as a Boy Scout leader, I might have that, all right? Okay, talked about the fact that we have that off his W-2. We're going to go back to our Schedule A, all right? We're going to start going right down the list of things that he has here. First thing is real estate taxes. So he had taxes paid. If I take a look at my taxes paid, I have my real estate taxes, but I have several lines here that talks about it, okay? The first one has the 8829. Again, something that will come up a little bit later when we get into self-employment. that $88.29 would be deductions for a home office. Well, if I'm taking that deduction, the portion of the home office or the portion of the taxes for the house that relate to my home office, they stay with my Schedule C. The remainder can be used on my personal side. Same thing for the next one down. It talks about partial rental. If I live in a duplex and I own the whole house, only the taxes that are for my personal side will be on my Schedule A. The remainder of the property taxes can only be used on my Schedule E, where my rental income is. Okay? Next one talks about real estate taxes. All right, principal residence, that's what we have. Okay? And then other taxes you pay not listed on the thing. That might be if we have a cabin somewhere. Okay? But for our example here, he paid real estate taxes of $29.45. So we're going to do real estate taxes on his personal home. All right? Now, up here, again, you can see the $12.38, okay? That number, if you remember, is his state tax withholding on his W-2. So it's carried over there. That state tax we pay out of our paychecks is something we can use on the itemized deduction. All right? Next thing down, we have mortgage interest. All right, so we're going to go to interest paid. All right? You can see a lot of the same things that we just talked about as far as categories and the different things for interest paid. So we're going to kind of take a look at all these. All right? Now, first one is home mortgage interest remainder. There's that form again, the $88.29, the home office. If we're going to use part of it for our home office expense, we can't use it on the personal side. Same thing with the partial rental. If we're using the mortgage interest for a house, a duplex that we own and live in half, we can only use half on our personal. The other half can be used on our Schedule E. Okay? Next one down says home mortgage interest and points from a Form 1098. Well, most of the time you're going to see mortgage interest reported on a 1098. That's where we would put that. The next one down, I want to talk a little bit. If I sell a house to somebody and I decide to hold the mortgage myself, well, that individual that I sold the house to, if their payment includes interest, all right, they can deduct it. Well, it's going to have my name and social security number on their return because I have to declare that as income. And if you remember on the top of the Schedule B, there's a spot we would claim that. Okay? So, two sides of the equation. If I'm holding a mortgage for somebody and they have interest payments, they can take the interest as deduction. But on the other side of the equation, I have to show it as income. Okay? So, again, in this example, we have an interest payment on our primary residence of $69.84. Okay? So we have that there. Again, below you see the points, maybe something that was on a closing statement on line 12, and 13 if there's any PMI that's involved that might come off the 1098. Okay? Next one we see cash donations to the church. All right? We're going to go back to our little detail worksheet. And here we can say that he gave money to the church, okay, in the amount of $260, okay? The real estate taxes paid on rental property is deductible, but not on the personal side. It is on the Schedule E, okay? As I keep saying, a lot of this stuff, when we see this parts of the Schedule A, some of this carries over from things that we're going to do later, okay? But as far as real estate taxes paid on rentals, again, the rental side stays with the rental property, okay? The personal side comes to the personal side, all right? Next item down, we have, well, there's the charitable donations withheld from his paycheck. We already have that one, okay? Work uniforms. Well, we've deemed that he has uniforms that he uses for work that are not ordinary. I guess security guard uniforms are not something you typically wear on the street. So that's where those work uniforms can be deducted, okay? So we're going to go down to work-related expenses, okay? So this is where we can put those different things in there. As you can see at the top of this part, we're talking about job expenses. So we have job expenses. We have a couple different options. We can put them in directly, okay, or we can put them out of 2106 EZ. So we have those options, all right, for different things that can carry forward, different ways to do that, to report those. Again, we're in a section where you can see down here at the bottom, before we see, we're going to have at least $775. What is 2% of his AGI right now, we can take, and we can see where that's at. All right? Now, we're going to try to do most of this for his business expenses on a 2106 so we can kind of see this in action. All right? Some of the other stuff we won't have on there. But because we have that, we're going to go in here to our square. We're going to line it up, hit F9. We're going to use his 2106. Okay? This little form, unreimbursed employee business expenses. These are things for him as a security guard. Okay? I can spell guard, right? Okay, so I have him as a security guard. Okay? Now, first little thing we have on here is mileage. We may come back to that. Anything else that we have, okay? But as you can see down here, it says business expenses not included in 1 through 3. A lot of these have to do with the vehicle, travel, things like that, all right? But you don't want to include the meals. We're going to calculate that differently, all right? So for the business, one thing that we can do here is say, okay, if it doesn't fall in that travel and it's not meals, we got work uniforms, we could put it on here. And one thing we can use, if we go in here, we have a little scratch pad, okay? Comes up with a little thing like this. Looks like just a blank sheet for us to do anything. And we can call it maybe miscellaneous job expenses. And the first one we're going to put down there is uniforms. All right, and if we put that in there in the uniforms, he had $75, okay? Now, we did that. If we go back to our Schedule A, all right, we can see that that's carried over onto his form, okay? So that's where we have there. All right. Now, let's go back to our 2106, and we have some other things here. We have union dues. Well, that must relate to his job. Let's go back on that scratch pad. We can put in there union dues, okay? And he paid $328, okay? Next thing down, professional publications. Maybe he has something that he has to subscribe to that relate directly to his job. Okay? He spent $139, okay? Next one down is tax prep fees. Okay, well, it looks like we're done a little bit for now with our business, so we're going to go back. And if we go down to our miscellaneous deductions, we can see on line 22 here that tax prep fees, we can put that in there, and they paid $152, okay? Next item down, safety deposit box. Again, if you take a look at line 23 here on the Schedule A, we can see other expenses, investment expenses, safety deposit box. Again, have some room here, but if we hit F9, miscellaneous deductions, we'll pull something up that looks very similar to our little scratch pad, but on this one, we're going to put safe deposit box fee, okay? And we'll put that on there, okay? Next one we have down, gambling losses. Oh, that's right, he had some gambling winnings. So let's go take care of those first, all right? Remember on other income, we're going to go to line 21 on the schedule, the Form 1040, all right? We're going to go in there, we're going to get our worksheet 7 where we put our other income. We have to report gambling winnings, and as it said in the bullet here, he won $500 on a scratch off. Well, we got that income in there, all right? Now, our Schedule A item is gambling losses, okay? So we're going to go back to our Schedule A, and remember gambling losses are other miscellaneous deductions. So down here on line 28, we would put our gambling losses, okay? If you do it on the bottom of a Schedule A, or excuse me, of a W-2G, it'll carry over here automatically. In this case, we have to do gambling losses. He had losses of $720. However, remember, he can only take losses up to and equal to his winnings. So we can only put in that $500, okay? Because there is a limitation on there. All right. Next one we have, sounds like another miscellaneous deduction, is legal fees for his divorce. Okay. Well, we're not quite sure on those legal fees. So I'm going to use my reference book here. I'm going to say, okay, I'm going to go to my Quick Finder, and I'm going to go in there and take a look. And I'm going to find the page for the client. Okay. And we have those legal fees. All right. Okay. We look on here. It does say something about divorce fees. Okay. Says only the fees for tax advice or to get or collect alimony are deductible. All right. So basically what it's saying is we can't deduct those fees to do the divorce, but if it says that it's here to get or set up alimony, okay, all right, then we can deduct it. So in this case, we can't use the legal fees, all right? Next one down says required training for being security guard, all right? Well, we're probably back on our 2106. Yeah, we don't fall under travel. It doesn't fund all under meals, but we did have some training. So we're going to put that on there is training. Sometimes these would be continuing education classes for keep their certification. All right. So we had $400. Okay. Next line down says mileage for training. Well, if we go back to our 2106, we can remember that there's a little thing down here at the bottom for mileage, okay? So he had some business miles. It says mileage for training in August, okay? So we have to put the car, and it says, told us that he's had that car since 2008, and he traveled 260 miles, okay? And we have to determine that everything was given to us written. And if you look, it calculated the miles for us, and then carried it up to line 1. All right. Next one down says tolls for work expenses while in training or away from home. Well, I can see I have a category on line 2 here, parking fees and tolls. We're going to put that one in there, the $20. Okay. Oh, we have another one on the next one, parking while he was away from home. So I want to add it. Little shortcut. You can hit the F5. Hit plus $10, brings up the calculator, hit enter. There's our $30 in there, okay? Next one has overnight lodging while he was away from home, okay? Look at line 3, travel expenses while away from home, including lodging, airplane, car rental. He had $280, okay? So you can see that we put that in there, all right? So we had a bunch of different expenses that he put in there, all right? So we can see on a Schedule A that we have that, all right? So our Schedule A is complete. Again, sales tax we're not going to worry about because the sales he already has his income tax, all right? The one thing I want to point out and have you take a look at is we're going to go to that little detail sheet and take a look at the top. This problem didn't have any medical, but we're going to talk about it, okay? Remember, all those categories that we had for our itemized deductions for medical that we talked about, you can kind of see some of them listed up here. All right? But again, don't limit yourself. Think outside the box. Okay? We have our medical miles. Sometimes that can add up. If somebody lives in a rural area and maybe they have to drive 3 times a week to go for cancer treatment to the local hospital, those are medical miles that they can deduct. Okay? Over here, we see that we have a little place for our insurance premiums. Okay, those insurance premiums, again, health, dental, cancer, anything that we have related to our health, only things that are not pre-tax. That means if it's on our W-2 and they're lowering our taxable income in box 1, we can't report it. All right. We have the next one down. We have what I was talking about in the qualified long-term care. Okay. If I have money in there, now in this instance, because of his age, if I were to put in there that he has a $15,000, okay, that he's paying on, you can see that he used that table that we saw in our book, and it limited him to be able to use $390 for his long-term care. Okay, now on the state side, remember I talked to you about the fact that it is a non-refundable credit. You can see here on line 42, there's the carryover. He had a $1,419 tax bill, but because he has that long-term care, it ate up his tax bill. Okay, so that's where that would come into play. All right, so we'll take that out of there. Other medical expenses, again, when somebody has medical expenses, a lot of times they can get a little report from their insurance company that may show out-of-pocket co-pays, deductibles, things that they paid. Maybe they call their pharmacy and get a list of the prescriptions and what their co-pays were. But on these, you know, you can simply do, I do RX for the prescriptions. You could do a line for co-pays. You could do a line for dental. You could do a line for vision. Kind of covered all those things. If they're in a nursing home, just give a recap, okay? And then say that they had foot surgery and it was a major expense in 1 year. You can maybe just have that as a separate category instead of lumping it in the copays. It gives us enough detail. You always have to make sure, again, as we talked about with record keeping with the client, that they make sure they have record on all this, okay? Further down on our little sheet, we already did the cash contributions. Here's the area again, 50%. If it's over $500, we can put that in there as far as our charity for the 50%. This is what the 8283 would look like for our charitable. Okay, you can see that I would put in my name, the address of the organization. What I usually put over here for description, I usually just type in household items and then go down the next line and put and clothing. Okay, down here below we can say when we made the contribution. All right, and then here for the value, you know, after we determine the fair market value, the method, you can just use thrift store pricing, kind of that goodwill thing that we did there. Okay, so that's kind of how to handle that 8283. All right. Okay. Any questions? Anything on the Schedule A that we did here? Okay. Again, there's a lot of material in there. I'm going to post this video as soon as we're done. There's a video I will post too from the classroom where I did some things where I talked about different things on the Schedule A. You can see different things that were there. You know, towards the end of the week, I'll send out the answers to the problems so you can see and check your Schedule A with the problems that you did in 10 and 11 to see where you stand on everything. Okay. All right. Any questions about the problem before I close it out here? Okay. Again, a lot of material that we covered for this week for homework. I'll send it out. But you know, read. You'll have the chapters that we're working on next. Will be just chapter 12 for the adjustments to income. But the other homework that you'll have is I'll be sending out today the midterm exam for you to send back to me. And then next week we'll be conducting the computer midterm. For those that will be online live, we'll probably just set you up and you can do it, send it out to you, and you can work on it on your computer. That way, while you're doing the midterm, if you got questions, we can work on it. Otherwise, I'll just have you, if you're not on the video, the live video, we'll have you submit that through the PDF procedure. Okay? All right. Thank you for everybody here today. Again, any questions come up, anybody has anything that watches this video later and needs help getting caught up, if you're local, come in and see me. All right? Here every day, other than the time I'm out of the office teaching. And you're welcome to sit on any of the classes or come in here and work in the office, and I can help you to kind of get you up to speed on anything that you're uncertain with. Okay? All right. Everybody enjoy the rest of the weekend.